chat box. Wait a second. What happened to it?
I'm seeing something that says our website.
Yes, that's it. That's it.
Yeah.
Can you hear me, Mo?
Yeah, I can hear you fine.
Okay.
Compared to last night, everybody is coming clear.
Yeah, Mo and I connected last night. Everything worked just fine.
And I was experimenting pretty much most of the day today. It was really frustrating. You know, you push the switches, nothing works.
Yeah.
And everybody has good suggestions, but you know, when you click stuff, it doesn't work.
What turned out to be the solution?
Starting a new session.
Start a new session. But somehow I was trying to start a new session. The old one wouldn't go away. The old one wouldn't go away.
You got big gremlins in Plano. That's all there is to it.
Yeah, there is somebody in background doing something.
So I apologize, Mo, but are we supposed to see a link? Right.
If you look at in the chat box, you should have this
This
link.
conference will now be recorded.
So if you look at the chat box, it says me to everyone. It says from me, I guess, link to our website. The next message is a link. If you copy that link, that's the website for IBD group.
Yeah, it ends in WHKR.
Yeah.
Perfect.
I see it.
Whose phone is ringing? Is that yours, Dave?
Yeah, mute yourself.
So is Rami new?
I'm here. Can you hear me?
Yeah, I can hear you, Ron. No, I said everybody says hello to Rami.
Yeah, Mo, I'm new to this group, correct? Yes.
Fantastic. Welcome.
Thank you.
So Rami, you just kind of arrived a few seconds ago. We have a website that you can download our stuff. And I put the website on the chat box.
Yeah, I saw that. Thank you.
Okay.
And I guess, Mo, is the same group that meets in a church in Richardson before COVID? Is that the same group or different?
Okay. In the church, it was actually two groups meeting at the same time. Yeah, this is half of that group.
I see.
You mean that was a Russ's group, right?
Correct. Yes, correct.
So is that group plus IBD group?
I see. Got
Yeah.
it. Thank you.
Russ was not happy with the church. He's thinking to start it again, but he'll be looking for another church probably. Okay, shall we get started? Yes. Yes. Okay, cool.
Yes. Sure, yes.
This is my email address in case you need to get hold of me. Tonight we are going to have a presentation on short put strategy. Short put strategy probably the second most common strategy after selling covered calls. When we do this, hopefully we do a couple trades, at least 2 or 3 trades. And we are going to review our trades we did last month, and we have to manage them. The key things to all of our option strategies, you have to manage them to make money. And then if you are interested, we can do some golden goose trades. Okay. So I'm going to start the short put spread strategy. Let me get to that application here. Okay, one thing is when I make the presentation, if you put something in the chat box, I don't see it for 10 or 15 minutes. Just say something, okay? Because I'm at disadvantage. I don't see. I don't know lots of people on these calls anymore. I used to know everybody when we made face to face, but that's not true anymore. So if you put something in chat box, you want to discuss it. If I don't get to it within 10 minutes, just holler at me, okay? So we start with a disclaimer. What's going on here? So everything we do here, it's for educational purposes. You can keep all your gains and losses if you decide to do any of these trades. And I basically highly recommend that you study this. You study these trades and do simulate them or do back testing. Make sure you understand what we are doing. Okay. Just a note: we have done a golden goose strategy, which is a long-term trade. It usually goes 1.5 to 2 years. When we did those trades, we didn't care too much about liquidity, because when you do a trade which is 2 years out, the bid ask is usually $5-6 wide sometimes. Tonight we are doing short put spreads, which is a very short term, usually 1 to 2 months long, and they usually close within a couple of weeks, 2 to 4 weeks. So when we do these trades, we have to worry about liquidity because we want to be able to get out quickly. And there are many variations to short put spread. And, all of them probably are fine, but you should study them. People, when we talk about short put spread, they talk about the width of the spread. I like 5 wide. Some people like 10. Some people like 20. Some people go 40. I have seen people going 100 wide spreads. So if you do 100 wide spread, you really should understand the consequence of doing it. I use always a delta less than 30, and some people like to look at support line as opposed to deltas. I'll discuss some of those tonight, okay? So tonight I'll do an introduction. Then I discuss the trade. Then I go through, show you how to select the underlying stocks or ETFs to do these trades. Then I'll show you how to execute the trade. And we talk some about math and psychology behind the trade. And we do a few trades after that. And we talk about trade management, what to do when the trade going your way or going against you. That happens frequently. And then we go through frequently asked questions. Okay. So on the introduction, people always ask me some references for the strategies. So one reference I use is Only Option Strategy book You'll Ever Need. That's by Russ Stolz. Now, Russ was the guy who was running all the meetings at the church. So most of you who came to the church bought his book. It's a good sized book, by the way. And The Black Swan by Nassim Taleb. If you have not read the book, this is one of the hardest books to read. But the only thing, the message you get from the book is crazy things happen when you expect them the least. Okay? So going introduction, options give us an amazing opportunity for income generation. There are hundreds of option strategies. If you look at the Russ's book, you will see that he has probably 120 different strategies. I believe it is critical to select only a few of those. I say less than 3. I only use two. I use a golden goose and short put strategies. And when you learn those, you have to get really efficient at them or proficient at them. So tonight we focus on a short put strategy, also known as a bull put spread. Okay. So if you had the book by Russ, you will see on page 381, he has like 4 or 5 pages describes the short put spread. And that if you have the book, it's a good thing to read. Okay. So put spread, short put spread is a bullish strategy. That means is a strategy that we expect the stock to go up. Also, it is a very forgiving strategy. I say forgiving because we can make money when the stock goes up. We can make money when the stock goes sideways. And we can make money when the stock goes down a little. Typically, when we do those trades, they're usually 2 to 4 weeks trades. Sometimes we have done trades in only like 1 day or 2 days. We do a trade, next day the stock gaps up, and then we just take our profit and go. Okay, the trade. So the next topic is the trade. So when I talked about Golden Goose, I gave you this watch list, IBD filtered. So when I was making this presentation, I think on Thursday, I said, okay, I'll do a trade on a FND. This is a IBD 50, and at the time the price of it was 114, and it had a weekly squeeze, 4 of them. It's a bullish stock, and when I did the trade, the sizzle index was 8. That means if you look at their activity, option activity on this stock, if you take the 5 days average, this was 8 times those. So I thought something is going on, interesting. And the IV percentile was a 99.1. So I thought it's a good trade to do. So that's the stock I took. I could take any of these, okay? So the trade is simple. You just come here. So I just put this bracket around the strike 105. And basically what I'm doing, I'm selling strike 105. Over down here, you can see that. Selling 10 copies of 10 105. Then I go 1 strike down, which is 5 wide. I buy the next strike down. Then I buy strike 100. For this trade, I'm getting $1.50 credit. So when I do the trade, I get $1.50 for 10 contracts, $1,500 credit. And notice over here, the delta on this leg I'm selling is 29%. Also, I show you one other column that we don't talk about. It's called probability of touch. Probability of touch is 65%. We'll talk about that later. So I put this trade on Thursday. Then on Friday, if you look over here, 4:30, about 9:42, the trade was filled for $1.50. Okay. So if you look at the chart, this is a Floor and Decor. This is kind of a company that supposed to be very strong. It competes with Home Depot and Lowe's. The stock, if you look at the moving averages, this is 8 days, 21 days, and 50 days. They are stacked on the top of each other. That tells me it's a bullish stock. And, it has been going up fairly well. Okay, so what I did, first, I sold, as I show you, a 105 strike put for $4.20. Okay. So what that means, when you sell a put, you are obligated to buy 1,000 shares, 10 contracts of Flora and Decor for 105. That means if the stock goes below 105, we are obligated to come up with $105,000. Okay, 1,000 shares times 105 becomes 105. Basically, this is the same as selling insurance. You're an insurance company. So the person who owned this stock, he basically bought insurance from us, and he paid us $420. We sold him for $420. So premium $4,200. Now, so 1,000 shares of F&D cost $116,000, right? Look how expensive the insurance is on these stocks. If you own a house, say $300,000 house, you insure it for 1 year. You pay $1,000, $1,500, probably. That's what I pay. You are paying a stock which is 1/3 of a house price, and you are paying $4,200. So if you have 3 of these, this will cost you 3 times $4,000, $12,000 to buy insurance. Just a side note. So $105,000 is too much liability. I don't want to take that much liability by selling this call. So what I do, I come here and buy 100 strike for $270. So basically, 100. When I buy this, the 100 strike limits my liability from 105 to 100, only $5. So my liability for this trade is only $5 times 1,000 shares is $5,000. So the credit I receive for this trade, remember I sold one for $420, I bought one for $270 times 1,000 shares, I get $1,500 for this trade. The maximum loss for the trade is $5,000. And if I subtract $1,500 from it, so my max exposure to a loss is $3,500. Is that fairly clear?
Yes.
Yes.
Yeah.
Yes.
Okay.
Yes, sir.
So by the way, insurance companies do exactly that. When you go to Allstate, you insure your house for $300,000. They charge some money from you. Then they go to another insurance company and buy insurance. They limit their downside exposure. That's exactly how the way insurance companies work. So we are becoming an insurance company by doing this trade. So how do we make money? So the stock, so here, this red, I sold 105 strike. I bought 100 strike put, right? I sold it, I put it. I have a concept called safety zone. So the stock is 110.92 at the time when I did this, and minus 105, I have a safety zone of 592. That means the stock could go as low as 105. I'll be okay with this trade. So we make money when the stock goes up. This is the ideal situation. If the stock goes up, we had trades before when we do these trades, the next morning the stock goes up like crazy. We take our profit, we are done. Sometimes it takes longer. We make money when the stock goes sideways. The stock could go sideways, we still make money. We make money as long as the stock is above 105. So when I say the strategy is forgiving, is basically what I mean. You make money if it goes up, you get money when it goes sideways, and you make money when it goes down a little. Okay, basically this is the trade, fairly simple trade. So I just give you a chart. So if you want to do these trades, this is the link. If you are a TOS customer, you know how to use this link to get the charts I have, the same charts I use in this presentation. So this is a short put strategy, a bullish strategy. We are looking for stocks that they go from lower left to upper right. And there are many indicators. Every indicator we use, they are a lagging indicator. The only one is real is the candlestick we use. On the charts, you have 8 and 21 exponential moving average and the 55 simple moving average. Then I use volume and unbalanced volume, and we use TTM squeeze. So if you would download this link to your Thinkorswim, you will get a chart like this. It has 3 panes. It has this first one is a weekly, 1 year weekly chart. This is a 3 months daily chart, and this is 15 minutes 1 day chart. Does everybody knows how to enter this into Thinkorswim?
Oh. Mo, this link is broken.
It's broken?
Yes, I tried it and it says it's broken.
Okay, no problem. I just make a note before I save the presentation to our website. I will fix the link. Okay.
So Mo, I tried it and I was able to access it and open the the chart.
So
Yeah,
you were you able to use it?
Yes.
Okay.
Okay,
I'm looking at it right now. Pull it up.
You know what? Let me do it right here. Okay. So
Yeah, put it on the chat box.
here. So this is the link here, right? I copy this. Then I go to Thinkorswim. And I go into setup. I say open shared item. I come in this box, type, just do Control V, say import. Preview, I'm sorry, preview first. Then it says this is the grid. I say import. That's the chart. So when you do this, you need to make sure to copy it. You come over here, you save it. You say save the grid as, you give it a name. Okay? So I think it's working. I don't know why yours did not work. By the way, when you look at these presentations, if you want to use it the same way I'm using it, you see this monitor here. If you click on this, you get this mode where you, where you can see step by step. Okay. If you had to print one page from this presentation, this is the one. Strike selection, okay? We choose a short put strike with a high probability of success. Delta is 30% or less. So delta 30% or less means we have better than 70% probability of success that, this trade will close with success. Then we buy a further put strike down. So the width, the definition, spread width is the distance between the short put and the long put strike. Okay. So, you can use different strikes. You can use 20, 10, 5, 2.5 width, or 1. I believe 5 is the best one. But, when I talk about this, people want to do 10, 20, some want to do 40. So the goal over here, make 25% return on risk. That's pretty good return, if especially for a month or 50, 60 days. So if you do a 5 width spread, we should receive $1. If you do a 10 wide, you do $2. If you do 20 wide, you should receive at least $4. And the way I calculate this is return on risk is basically, you get $1 for $5 wide strike. 5 is your that's pretty straightforward. If you receive less than 1%, then your return on risk is a lot smaller.
All market conditions, like neutral, bearish, bullish.
Okay, this is a bullish strategy, right? So we are looking for bullish stocks and bullish markets.
Right, and then yes, yes, of course. But so the question that I should have asked is, if you were to use this in a, let's say, a neutral market or a market that is uncertain, the doji telling you uncertainty and stuff like that. What would be the outcome if you were to deploy a strategy with this?
I think a neutral market, this works fine. But it doesn't work if the market is crashing down.
Okay.
Okay. Typically, the markets go up. Okay. Especially the last couple, 2, 3, 4 years. I know when I've been doing short put strikes, all of them make money. I think I only had in the last 15, 16 months, I only had one of them that didn't work for me. And one unique thing about this presentation, I'll show you what happens when the trade goes against you. You just don't give in right away. There are ways to manage the trade where you still can make money.
Mo,
Yes, Alessandra.
but you can also apply this strategy on a bearish market. You just do the same technique on the call side, correct?
The problem with the call side is the market usually goes up then down, right? So even though you think the market is going down, I have not had success myself with selling short call spreads.
Okay.
Because the market have a tendency to go up.
Yeah.
Hey Mo, the 25% you mentioned return, is that assuming you hold it till expiration, or do you close it out as soon as you make it 25%?
Okay, if you just wait 2 slides, I'll explain that to you.
Okay, sure.
No, we don't wait to expiration. We want to make some money as quick as possible. Okay, so just give me two slides. I'll cover that. So when we do trades, we do them 20 days. I used to say 20 to 60. Now I'm saying 20 to 70 days. I'll explain to you why. So this trade, I'm just example. I'm using Win. Win is the Win Resorts. It's a gambling thing. So this trade expires in 48 days. So I go on this column, it says delta. I look for a delta less than 30. So in this case, I look at delta 23%. What delta 23% means, the probability that the stock closes 1 cent below this strike is 23%. That means your chance of success is 77%. You subtract 100 from 23, you get 77%. That's pretty good success. Now, I show you one other column. I couldn't get it print in here because it's a long name. It's called probability of touch. The probability of touch is 53%. It means that there is more than 50%, like 53%, that the stock will hit the strike. The point of showing you this probability of touch means don't get scared if the stock goes, the next day comes touch your strike, touch this 115. It usually goes the other way. Okay? Now, the point you made was, this is a risk profile that Thinkorswim uses. On this axis, I have the profit. On this axis is stock price. Okay? So this is on the win trade. I basically bought, I sold 115 strike, bought 110 strike. Okay? So I'm getting $1.04. So my maximum loss is 3,960. I'm getting $1. This over here is called time zero or current time. This means how the stock is doing today. This other black line is the behavior of the trade at expirations. So as you see over here, for me to get 100%, the stock could go to 500. I still will not get this. This line start becoming parallel with this line. So I will not get max profit unless I wait until expirations. So what I do, I try to close this trade at 68% profit. So basically, when I make 1,040 times 68%, when I make 682% or $682, I will close the trade. Does this answer your question? You have to unmute yourself. That's fine. We'll cover this a lot more as we go through the presentation. So one thing, again, realize this is a maximum margin for this trade is 5,000 for 10 contracts. But we got 1,040 there. Also, theta is positive. That means this trade makes money if the stock even doesn't move. And safety zone, remember we sold 115, the stock is 128. So I have a safety zone of $13.40. The stocks could come down $13.40, I'm still safe. Okay, so I'll go through explain how we do these trades. But before I do that, how we select the underlying stocks. So I have talked a lot about this before in the previous presentations. There are lots of stocks. There are 19,000 stocks in US, but less than 3,000 of those stocks are really optionable for us. So if you Google all the stocks, you will see there are 15,000 stocks in here, another 4,000 on the main index. But we don't care about this 19,000 stocks. We only worry about 300 of them. So the way we select this, I have a watch list. for short put spread. Basically, what I'm doing, I am looking for stock with liquid options. So the way I do it, Thinkorswim has a watch list called penny increment options. I start with that. Then I remove all the stocks they have. They have less than 1 million shares trade per day. I think I'm doing 20 days moving average. Then I look at the stock price over 30. I don't want to mess with the stocks, like $10. Then I go look at the list. There are lots of stocks in here that I have no interest in for whatever reason. You look at them, you might not like them. And basically, I come up with 176 stocks. And if you want to look at these stocks, this is the link. You can copy this to your Thinkorswim, and you get a watch list like that. Okay, so this was, the first, I think, 100 of them. So there are a lot more in here. So for tonight, I am going to do a few trades. And I like to pick one stock from this group before I go to the next group. So this is the watch list. Okay, it's just taking a little while to do all the calculations. Also, I have given you this all the studies in here. You have lots of custom studies. If you go to the previous couple, I think last month's presentation, I'll show you how to do this. Now, I think Thinkorswim is super busy right now, and it takes them a while to do all the calculations. But we don't care right now. So I can look over here. One thing I like is when the stock pulled back. So I can here look at the net change today. Okay. I can see today Amazon pulled back $74. They also pulled back yesterday. NVIDIA pulled back $19. Roku pulled back $15. So one way I like to choose, I like to select stock. I look at like Amazon. It's pretty strong stock. They announced their numbers. They did really well. Between yesterday and today, this might be a good candidate. NVIDIA is a good candidate. Too low, I don't know. Roku is a good one. Adobe, Tesla, Lulu, PayPal. I think Roku is pulling back because they have a argument with Google. They have a YouTube and YouTube TV on Roku, and they are negotiating for a longer-term contract. So there are some issues there. So is anybody interested to look at any of these?
Absolutely.
Okay.
Yes.
So we have to pick one. I will get back to it later.
Can we choose Roku?
You want the Roku? Okay, we can do. Okay, Roku. PayPal. Okay. So let's. So I have a few other watch lists for you. So we'll look at two. We got the Roku and PayPal from here. Okay. So going back to our presentation. Okay, so the other watch list you can use, I always, when I have classes, I make this group, IBD 50 stocks this week. So usually IBD changes IBD 50 on Wednesday. So I made this over the weekend, so this is still valid. Also, I give you the changes from last week. They removed Goldman Sachs, all the stocks from here. They added this over here. And these are the stocks. By the way, if you want to use this list, this is the way you get them into your computer. And this is the list. Also, if you go to our website, I give you a Excel format of this table. Basically, it has all the stocks. It has the rank. It has the price change that was on Friday, change, and the PE ratio, composite rating. These are all very high rating, all 80, all higher than 80. Earning per share rating, relative strength. You can look at the columns. So when IBD look at the stock, some of these stocks are cheap, some they have no options. But also I look at this. I have another service I use called Shaking. Shaking look at fundamentals. What IBD looks at. Also look at the stock. So IBD focuses on the company. Shaking focus on the company and the stock. And you see down here, some of these Shaken consider them bearish. You see at the bottom of the list, but the top ones, they are all bullish stocks or neutral. Okay, then I do one other thing. I use a filter. I remove so I start with IBD 50. I remove the ones that have no options. Then I look at the stocks over 30. Then I look at the stocks that they have over 750,000 shares trades on a 20-day moving average. Then I come up with 21 stocks. So if you want to look at this list, this is the way you can take them into your computer. And so these are the 21 stocks. Then I run them against Shaken. Again, you have some of them Shaken say they are bearish because lots of them, they have moved too fast, too quickly. But these other ones, they are all good stocks. So I like to take one or two from here. See which one you have interested. Jeff, I don't know. This is a very inexpensive stocks. LPX, that's a good one. ASML is a good one. DR Company is good. DHI is good. So help me to select two of these.
DE.
Which one?
Dear.
DE.
DE.
Yeah,
okay.
I like that.
DE.
Hey Mo, it's Alicia. I like DH Horton, DR Horton, and ASML.
DHI. Okay, DHI is good too. And SML is good. See, the problem is we have all ASML, right? We have all these good ideas, but not enough money to do all these trades. Okay, the next group I always keep in my mind, these are opportunity stocks. Sometimes after earning release or other events, the stocks get punished despite their good performance. So in here, if you look at last week, so I did the slides on the weekend, Apple report good numbers. They got destroyed. Microsoft, Amgen, TI, and Netflix. So when the stock, they gap down like this, the new lower price becomes a very strong support candidate for short put spreads. So do you have any ideas of which one of these you want to select, or they have been destroyed?
Netflix.
Netflix.
Skyworks.
Which one?
Skyworks.
What's the ticker for it?
It's SWKS.
SWKS. I never have traded in Skyworks. Okay. So when we get to the trade part, I will do some of these trades. Okay. The next thing I want to talk about, execute the trade. Okay. Okay, so the rules for short put spread, we find a bullish, a stock with a bullish trend is going up. We use only monthly expiration options because, first of all, you have much better liquidity on those. Second, in my situation, I have hundreds of trades all the time. I only have to worry about them once a month, as opposed to every week. Then I look at option expiration, 20 to 70 days. And I like to have open interest on the, say if I do 10 contracts, on the short strike, I want to have 10 times the number of, if I want to do 10 contracts, I like to have 100 open interest. And, typically the stock I've showed you, they have a narrow bid to ask spreads. And the delta in the short leg must be less than or equal to 30. And I do $5 wide is the preferred. And for $5 wide, you should receive at least $1. Sometimes you don't have $5 strike, you have $10 width. For those, you should receive at least $2. So again, I take profit at 68%. I don't wait until expirations. And the stop loss at 105. So if it goes against you, you have received $1. Now, you have lost $1. You have lost $1 more. You want to close that sometimes. I give you a template how to do a stop loss, but I highly not recommend it. So I just put this bullet here for completeness, but not recommended. Typically, when we do these trades, they close automatically in a few weeks. We analyze the trade a week before earnings release. So if you have a trade and you have earnings release coming next week, I have some other slides explain to you what you should look at. Then we start monitoring trades 3 weeks before expirations. So if I do a trade right now for June, I'm not worried at all during month of May. Then I start looking at them, kind of early June. And we do automated profit taking. Okay, so why we close contracts at 68% of max profit? One of the reasons we want to take profit as soon as possible and close the contracts. We want to take our profit. We usually can get 68% profit quickly. And I used to do them 80%. I used to do them 70%. I have settled down on 68% because lots of people do 70% nowadays. So going with 68%, I can close my contracts, take profits just before then. And I believe 68% is a good rule of thumb. Some people, they like to take 50% profit. When you go with 50% profit, you even can close quicker than 68%. But then you leave some money on the table. To achieve 100% profit means we must stay in the trade to the expiration day and take the risk that the trade could go against us. Okay, so what I want to remind you, bulls make money, bears make money, and pigs get slaughtered. So if you wait to expirations, you are asking for trouble. So I showed you this slide before. This was, again, the win. So we don't wait all the way to expiration, all the way to here. As soon as it hits 68%, we are done. So this trade, again, has a theta of $10 a day, maximum risk was 5. And, the key here is you want to close it as soon as possible. So the way this works is typically, just a second. The way this works is this line over here, as time goes by, it just keeps on going up toward this dark line. So basically, you can look at it like this. So this line over here, as time goes by, it just keeps on going up there. So you get to this line either by stock going up or time decay is helping you. 2 ways to make money. Okay, so taking profits. I think we know this well. Traders are very good at getting into the trades. They have a hard time to get out of the trades with profits. So we want a 68 profit on each trade. We have a trade template where the closing order is queued as soon as the trade is executed. So we do. I give you a template. So as soon as you do your trades, when the trades get filled, automatically it generates another closing trade for 68% profit. And when you have this other trade, when you put your trade in, you don't have to worry about what to do next. And the trades get filled when you expect them the least. Okay, so this is the template. Again, if you want to use this template, you just copy this to your thinkorswim. And basically what it works is, so this was a THO. So I start a trade. I'm looking for $1.45 profit. This trade is called one first trigger all. That means as soon as this trade fills, this other trades become active. And this other trade, it says when I want to close it at 68% debit. This template has no stop loss. You can change the closing percentage. If you want to do 50%, you just come here, bring this up, and you change this to 50%. If you want to get 40%, you just change this number, then save it. So it's critical because I do 2 or 3 days, I do like 6, 7 of these a week. So as soon as I put the trade in, I have the closing order also. So I don't have to worry about what to do next. So I have another template that, this is another template. This is a short put spread with close for profit and stop loss. This is the template for it. I just give you this because some people always want to have stop loss. But I'm telling you, this is not a good idea. So again, this order, when this first order fills, one cancels the other order. You either take profit or you close with stop loss. So again, this is not recommended. I just gave it to you for completion. So the way you use the trade, so this is the Apple, for example. You come over here, you want to sell this strike, 170. You say sell custom, and then you collect credit spread. And the way this works is the trade generates is 170 and one below it. So it's 167.5. Then you need to come over here, change manually, make it 5 wide on all the legs. Okay, I want to emphasize this again. Sometimes stop loss takes you out of the trade prematurely. You have market spikes, you have volatility spikes at the market open. That's the most dangerous time. Sometimes we get a fill, but the mark is much lower than the fill price. We get stopped out, we take a loss. Also remember probability of touch. Even though you have 30% probability of success, but the stocks could go down for a day or two. So again, most of the people I work with, we don't use stop loss. Short put spread characteristics. We receive a credit. Also, the broker allocates some of our money called the margin in case the trade goes against us. Theta is positive. You make money every day with time decay. The bottom line, this is a bullish strategy, and we want the stock to go up as quick as possible. Okay, so this is the trade. This is the way we do trades. I have a section on math and psychology. Those of you who have not taken a psychology class or a statistic probability class, I will explain this in 3 or 4 slides. Okay, so the market is unpredictable. Every morning you wake up, candles are created by buyers and sellers. Sometimes they go up, sometimes they go down. Today is a good example. It was a crazy market. There is no reason for it to go up, but to go down like it did, but it does. We increase our edge by knowing, so remember 70%, delta 30 and delta 30 and 70% chance of success, but we do better than that. One is the market goes up more frequently than goes down. So that's an edge for this trade. This is the reason we do short put spread instead of short call spread, because you expect the market to go up. There are certain candles and chart patterns help us increase our success. We can use squeeze indicators from John Carter. And our trades based on 70% success, we increase our odds by 10 to 15% by picking up the right stocks. There are no guarantees, but there are possibilities. So this is a short put spread is the probability game. So to explain that, if you have just a coin, this is a dollar coin, I think. When you flip a coin, you land 50% on head and 50% on the tail. So if you flip it again, you might get a tail. If you flip it again, you get a head. And you flip again, you get 2 heads, 2 heads next to each other. Then it will be a tail. So every time you flip that coin, you really don't know what's going to be. So each flip is independent of any previous flips. Like the market. Every day the market opens, it does something, a lot of time independent from previous. Sometimes we might get multiple heads or tails in a row. So we should not be surprised when we get 5 tails in a row. And however, we know if you flip this coin 100 times, most probably you get 50-50. You get 50 heads and 50 tails. So that is a 30% probability. So this is a fairly simple concept to understand. Each flip is a new event. Each day the market open is a new event, and we have a tail or we may have a head. We do not expect a specific thing. Sometimes you put the trades, the next day you are close, make profit. Sometimes it takes a while. So what happens if we have a coin that is not 50-50, is 55 and 45? So again, we go through probabilities. Every time you flip the coin, you have no idea what's going to happen. You get multiple heads, multiple tails. But if you do it 100 times, most probably you will get 55 times head and 45 tails. In other words, we can predict the results fairly accurately when we know the probabilities. Now, casinos, when you go to casinos in Oklahoma, they have 4.5% edge versus us, we have 70% edge. So the system, the way the law goes, every time you put $1 bet, they guarantee make 4.5 cents. They follow the rules, like we have rules here. They take into account customers who win 20 games in a row and walk away, and the customers who make bad decisions. But casinos know they make 4.5% on every dollar you bet. So one key thing they do, they manage their money. So they do not run out of money. So that's important. So when we do our trades, we have to do small trades. So if 3, 4, 5 goes against us, we don't go bust. They do not sweat every customer win. A customer win is a business expense for them. So how does that edge relates to our trading? So we have 70% edge. We use bullish stocks, and therefore every trade has 80% chance of success and 20% chance of failure. Every trade is like flipping a coin. We have no idea one will be a success and which one going to be a failure. We should consider losing trades as a business cost when you lose one, and we should not allow multiple losing trades discourage us from trading. One thing I have to warn you, when you have too many successes, that becomes dangerous. You become overconfident. So now again, when you use your edge, you follow the guidelines. We have no idea or expectation which trade is going to be winner or the loser. So the idea is every time you do a trade, you just execute them. Don't be afraid, and it works for you 80% of the time. Okay, is 80% probability of success is real. The probability of success are real, and most trades behave accordingly. However, there are situations the stocks behave abnormally, the stop gaps down due to news, downgrades, earning releases. If you have seen this before, in a lottery, when you go buy a lottery, you pick 6 numbers from possible pool of 49 numbers. Your chance of winning the jackpot, correctly choosing all 16 numbers, are 1 in 13 million. That's one shot in 14 million. It's a lot worse than our trade, but somebody does win. Okay, so I have been working with lots of my friends trading over doing options the last 15 years. So there is a mindset that you should develop when you do these trades. When you have a winning trades, it really doesn't mean you are genius. You know, we had people last year trading, they have made over $1 million with some of the trades we have done in this group. And, you know, anyone can have, you know, last year was a fantastic year. The market was up all the time except February. And it only proves that your strategy, your edge worked for you. When you have a losing trade, it doesn't mean you're a loser. There is no conspiracy against you. It only proves your edge did not work to your advantage on this specific trade. You should look at losing trade as the cost of doing business, like buying stamp or office supplies. Now, I have seen people who do these trades, after they are super successful, they become arrogant. They feel like a genius. And I'm sorry, this is duplicate. Okay, I have an extra slide there. So they feel like a genius. They start increasing the size of the trades. So instead of they used to do 5 contracts, you know, they go to 10 contracts. All of a sudden, they do 50 contracts. And when you do stuff like that, you know, your account would go bust with a couple bad trades. So not following the rules on earning release, open interest, liquidity, you make mistakes. So again, don't become overconfident. When you start making, you know, I do 10 contracts all the time. When you do 10 contracts, when I'm super successful, I don't go to 20 contracts. I just stay where I am. And over time, it works out. So some other people, when they are so successful, they feel they don't deserve the money, and they start making destructive choices. Okay. So this is pretty much on the trades. So we want to do a few trades over here. Okay, so we have picked a few of these. We'll start. So you want to do Roku or PayPal. So I do one from each group. So we're going to our account. I have enough money to do trades. This is our account that I do trade in this group. I always do one contract. So we come over here, we look at Roku. So is there a preference between Roku and PayPal?
Roku has earnings tomorrow.
Is it before the market or after the market?
That I don't know.
We can look. We can look. You can look at the chart.
It's after, it's on 5/6.
5/6.
5/6 after the market close. So today is the 4th. So it's not tomorrow, the following day.
Okay, got it.
Okay. Now, so look at Roku. It has really gapped down. And it came down $15 today. Okay. So if you do these trades before earning release, it's very high volatility. Okay. Usually you get a lot more credit. You can receive a lot more money than normal. So let's look at the trade. So to do a trade, we can do May because only 17 days. We can look at June, that's 45 days. And if you look at Delta 30 over here, we can go Delta 30 or 29. Delta 29 puts me at strike 290. Okay, so let's look at the chart, see where that is on the chart. So the strike 290, so the way I do my stuff, I come over here and I just put a support line over here, put a line over here, and for puts, we said it's a 290, right? And I make them this color so I can see them. So the stock is 319, that's 290. It's about 20 off, right? 30 points. Okay. So I go into trade, I go trade tab, 290. I said, I put my cursor, right click. I sell custom, and I use my my template, credit spread with no stop, gives me $1.72.
Yeah.
That's not shabby for a
Yeah.
for a 10 wide put spread, is it?
Is it a 10? It's a 5.
No, five.
Yeah.
No,
That's great credit.
that's great credit. Now, those who trade with me for the last 10 years, they know I'm always greedy, and I ask for more money than $1.72. I'm going to ask for $1.75. So this is a trade. Oh, screwed up. So we go to 290, sell custom, no stop. So I'll change it to $1.75. Don't be too greedy here. It's good till canceled, and this is the closing order. That's it. And I am going to so first I'm going to put the trade on the chat box so you have it. So I copy the trade. Now when I give it to you, you only have the opening trade. You don't have the closing trade. So I'll send it to you. You can have it. And I'm just going to make a copy of this so you can see it. Control. Oh, you know what?
So
I don't know why this is 10 contracts. It should be 1 contract. Paul, you say something?
I was just gonna point to the number of contracts, that's all.
Yeah, okay. You always catch my errors. Thanks.
I know. Quick question. The template that the link you gave to us, how do you link to that template here in the order entry screen?
Okay, so the template I gave you, you copy it, go to Thinkorswim.
Right, imported it. Once I import it and it's in my system.
You save it, give it a name.
Okay.
So the name I gave it in my system is sell custom, is a credit spread with no stop.
Okay.
Okay. That's it.
All right. So when you're ready to
move.
Okay. So did I answer your question?
Yes, I'm done. Thank you.
Okay. Somebody else said something?
One question. So how do you know that the credit that you, yes. So how do you know the credit that you have received is a good credit for this spread? Because today the volatility was low, and tomorrow, if it like a few days ago, the volatility was 16, 17, and now it's 20. So the credit that you sold would be more expensive today than 2 days ago, or if you did this a month ago, like 2 weeks ago. So how do you understand that part?
Okay. I mean, so I made a comment. I said something like, as you get too close to earning release, the volatility goes up, and you end up getting more money for this trade than normal. But assuming there is no earning release, you look at a minimum you want to get for this trade is $1. But we are getting $1.75, which is a lot better. Also, we looked at that trade and we realized that the stock has gapped down so much. The stock has gapped down so much, and we are even further out. So if you look at the support line over here, we are kind of below that support line. So the low for this stock for the last month has been 292. We are even below that. That's something always Peter worries about. I can look at instead of 30 days,
Earnings are in 2 days. You got to watch out for this deal.
right? I mean, this is a strong company. So if you look over here, we have this support over here, and the stock could gap down $30, which is 10%. We are still safe.
Okay, so we are looking at our overall outcome and not worrying about the credit. As you said, we're getting more than $1, we should be happy.
Yes, yes. Yes, that's exactly right. Okay, so we come over here in the trade. So the way I do this, I basically come over here, I make a copy of this. That's the copy. And I'm pointing out that this trade, the delta is 29%. And also I'm telling you, I'm asking for a few cents more, just being greedy. I copy it and I go to our presentation slide. I put it right here, paste. So this is a short put spread on Roku, right? And I see lots of stuff on the chat. Anything I should be worried about? Somebody said they want to do short put spread on QQQ.
Alessandra.
That's me.
The theta on short put spreads, when you put them on, is usually positive, okay? So let me finish this slide, then I come explain to you here, okay? So I come over here, I copy this. And by the way, when I give you those links, you can import those links into your account. So this is the, what did I do? Okay, so this is our trade. So you have everything in the so when you download the presentation, you have everything. Now, somebody said sometimes theta is negative. So let's look at it. So I come over here, right click in here. I say analyze the trade. Okay. And okay, this is our trade. So if you look at this trade, our theta is positive, right? And our vega is negative. That means this trade makes money if the volatility goes down. So if you get filled after earning release, volatility will go down and it's going to be to our advantage. Tom, does that answer your question?
Well, I've had a trade where the theta is negative. What does that mean? Will it start to go positive, or why is it so low?
I mean, this is only one contract. If I had 10 contracts, I usually have, that theta would be $11, 10 times more, $11.80. That's only one contract. When theta is positive, means it means when you are this part of the chart, it means, you know, I'm sorry, let me get rid of this. It means, ignore this one. It means, you know, you are going this way. Theta becomes negative if you are here in this part of the chart. So that means, so this, like you make money when it goes up, you lose money when it goes down. Forget this too. This is theta negative. That means this line has a tendency to go that way. Okay, make sense? Okay, fantastic. Okay, so we did one trade. Let's do another one. We decided to do a. Okay, so we did on a.
Question?
Yes.
So you've set up a target to exit free with a 68% profit. How do you manage if it goes against you? Do you just keep an eye on it, or what is your process there?
Okay, so I am going to have a whole section on managing the trade.
Okay.
After we do these trades, that's what we'll do next.
Okay.
Okay. That's the most important part of the presentation. So I'm going to queue this trade. So when I queue it, it says this trade will give me $175. Maximum loss is $370, and I don't have that much money in the account, so okay, send. We can look at it next time we meet. Okay, so from the IBD, we had 3 stocks: DE, DHI, and ASML. How is about doing DHI? Or DE, which one do you like?
How about DHI, please?
Yeah, DHI looks interesting.
Say again?
DHI.
Okay.
Construction market is hot.
Yeah, they're making money. So if you look at the chart on DHI quickly, this is really bullish, right? So what is the support line here? Is the support line over here? 73? Or the support line is the lower Kilter channel, or support line is 20-day moving average, or it is 50-day moving average. So that's something you have to figure out for yourself. But let's see what kind of trade we can do. So DHI is 101 right now. And we can go delta 34, or that's two. I've got delta 27. Okay. Delta 27. I come over here. So strike 95, remember that. I say sell custom, credit spread. So notice this is 2.5 wide. So 95, I'm going to make this 90. Give me $1.02. So I have to make this 92. Okay. And so the strike is 95. Let me look at the chart here.
Let's hit the 21-day moving average.
Right, that's 96, right? It's slightly below that. I change it to the right color and make this 95. So we decided with this trade, we are going to be just below 21-day moving average, and earning release is behind us, right? And they have a dividend coming in a few days. Usually when the dividend come in a few days, the stock will go down like 20 cents or something. And if you look over here, it rarely touches on the last month or so, the 21-day moving average. Even when it went below it, it kind of came back again. So that's probably a good one. Since we have this dividend coming out, I am going to ask more than $1.05. I'm going to ask for $1.15. Because when the dividend hits, the stock will go down slightly.
That's not very much premium, Mo.
You want another trade?
What?
Okay, so let's look at DE. The beauty of this, let's look at the DE, see how that works out. We are becoming greedy with this high volatility. Okay, so DE is a very similar situation. They had some pull, no, they even went up today with the crazy market. They are on the lower part of cultural channel. That's a good thing. It has a sideways action. If you look at DE lately, I think the real money is in ASML. Look at ASML. They were down $25 today. Okay, and if I look at 30-day moving average, kind of makes it nicer. You can see it. So today really gapped down to the lower cultural channel. It touched it, but then it went up. So we can, let's see what we can do here. We can look at a trade, and we go to 45 days. And to go to delta 30, so we go delta 26. So these are 10 wide. Notice 898, 580. So we have to get at least $2. We probably get a lot more. So sell custom. I think Paul always wanted to do a trade on ASML. This is his chance.
Thank you.
Yeah, we can get 220 for this. So how is somebody asking for 250?
Yes.
Why not?
If you don't get filled, we don't get filled. That's no problem. So this is our trade. 10 wide, more than $2. And ASML, Paul, could you explain what ASML does while I'm doing this?
Semiconductor.
They are used in fabrication of semiconductors at the nanometer size, and so the latest technologies that are have very small geometries have to use this machine to make it possible. So it is not an option to have this; it is a must-have.
And they are the only game in town.
Yes.
Okay. Thank you. So it's nice to have technical people in the group. They know what they are talking about.
So let me just add, because of this and because of the sell-off, and we're not going to do it tonight, but this may be a great golden goose candidate.
That's true, but that's too expensive. But I agree with you.
Mo, that brings up a question, if I may.
Sure.
How do you generally decide between whether you're going to do a short put spread short term, or you prefer a stock for the golden goose strategy?
Golden Goose, to do this trade on Golden Goose, it takes lots of money.
No, I'm not talking about this stock in particular, but in general, how would you decide? Because the Golden Goose is a long-term strategy, right?
Yes. Yes.
So how would you decide to do the Golden Goose instead of a short-term short put spread?
We can do one or the other, or we can do both. If I get the chance, to show you some of my accounts, and lots of my accounts, I have both. If I have a stocks I like, I have a Golden Goose and a short term. One of my favorite stock is Texas Instruments. I always have a Golden Goose, and it moves slowly, and I make money every month on it.
So one is not exclusive of the other in these strategies.
The amount of money it takes to do one or the other, that's really what makes the difference.
Okay.
Like this one, so we are getting 250, right? We only need for one contract $750 margin. To do this thing on a Golden Goose, so you might need like 5,000. That's a different trade. Also, I was listening to somebody. Golden Goose is not for everybody. Some people don't have the patience to wait that long for a trade. It is basically the preference. ST asks, should the IV be high or low? I think when we go before earning release, when IV is high, you get more money. Also, you have more risk. Okay, so this is second trade. So I'm going to copy this. I'll put it on the chat box. And confirm. Oh, this is one contract, guys. What I put in the chat box was 10 contracts. We need to make it one contract. Paul, you didn't catch me on this one. So you can see over here, my maximum loss is 750. My maximum gain is 250. So one of the most important part of this presentation that you don't see anywhere else is going to be how to manage the trade. Okay?
Just a quick question, Mo, before you get to the next section. You said you risk 250, you risk 750 to make 250. So it's a 1:3. Is that the typical ratios that the short put spread we should target for?
Yeah. I said the minimum is going to be $1, right? But
right.
Usually we get a lot more than $1.
Got it. Okay.
Usually we get a lot more than $1. Okay. So let me go over the next section. If we have time, I'll come back, do more trades. Okay? Because this next section is if you have to do one section, this is the one. Okay? Because you don't see this section in many places. They talk about how to get into the trade. They never talk about how to manage your trade. Okay, portfolio management. The key message is the market is unpredictable and black swan event can destroy every asset type. So the way I look at this, if I have my account, I only trade 25% of it on trades. The rest is usually cash. Okay? So the other 70% is usually cash and liquid. The reason is, we don't know what's going to happen tomorrow. The market could gap down a lot tomorrow morning. So I don't want to lose everything, be homeless. By the way, have anybody seen this new movie called Nomadland?
Yep.
Okay.
Yes.
That's a must-see movie. The number of people who have lost everything they had because of some financial crisis is just unbelievable. So
yep.
So that's that bought a lot of Oscar, by the way. I read the book and listened to the movie and saw the movie. So you keep the other percent in a safe situation. If the market crash, if you have that much cash, you can do all kind of trades, make a killing. So last year when the market crashed, in March, at the bottom, we did a lot. I did lots of trades. Okay, that's portfolio management. So managing trades. So this is the most important one. When we do this trade, we don't look at them every minute. We don't worry about them until 3 weeks to expirations. So like the expiration for month of May is about 3 weeks from now. So that's, when I start looking at my trades, trying to see, it's like making a stew. You have to let it cook. Sometimes the stock goes below your short put. So remember the probability of touch. If you look at that number, it shows that, lots of times the stock goes below your strike. You don't worry about it. Usually it takes care of it itself. So about 3 weeks before expirations, I make a list of all the short put spread expiring this month, about 3 weeks. And if you have a big portfolio, you can worry about that. You can do that by sorting your account by the number of days. I'll show you. Then I'll make a list of short put spread that expiring this month. So for one of my accounts, this is the list. If I have minus C, that means I have a short call. If I have a short put spread, like I have a short put spread on Crowd, I have a short put spread on Dexcom, a Genrag. I had a short call on IBM, it failed. It took care of itself. I had a short put spread on Net, and that one closed. Lots of had that trade. I have a short call on Synopsys. I have a short put spread on Synopsys, TSM, and Zoom. So I make a list. Then between now and the next 3 weeks, I look at this pretty much every other day and see which one failed, which one I should worry about. Okay? So one kind of quick comment. If you have a short put spread on a stock that has earning release in a couple of weeks, and you have some good profits, so say a 50%, not 68%. And you worried after earning release that the stock could gap down. So I usually close the trade. I won't be greedy to get all the money. I just, so if I have like $700 or $500, I take the profit. And I always tell people nobody can blame you for taking profits. Okay? So this is kind of a side note. So look at the stock that have earning release, and look at your trades. If you have profits, just take them. Okay. So if you don't do this, you could make a profit into a loss and you have no control. Okay. So managing the trades. So we don't worry about the trades until 3 weeks to expirations. So there are 4 conditions could happen. One is the trade goes your way and closes with target profit. Fine. As soon as that closes, you do another one. Doesn't have to be on the same stock, it could be a different stock, but you release some margin to do a new trade. Some delta on the short put is around 30 to 40%. Don't be scared, be patient, and analyze the chart. So I'll go through each one of them with examples. Number 3, delta is at 50% or below. So the stock is below the short leg, but above the long leg. So what I do in here, I leave the current closing in place, and I do roll it to the next month. So I will explain this again on another slide. Number 4, the stock has gap down and below the long put. You think the stock will come back and give you time. So you want to save, even though you have a loss, the stock has really gapped down. Sometimes you are able to, to save the trade. Okay. So number 1 is fine. We don't have to talk about this. You took the profit, you are happy. So number 2, the delta on the short put is around 30%, 30 to 40%. So I have this trade on crowd, CRWD. I have 20 days to expression over the weekend. Nice, even lower. On this trade, I had $3,000 of profit. And to buy it back, it cost $2.66. The theta on this trade is $54 a day. So to close it, it costs $260. So the current profits are, as I explained, $3,000. So on these, I just be patient. Now, if you look at the chart for this, the risk profile, you can see the current gain. You can see the maximum gain you could have, some more, and the difference is here. So everybody is different. Some people have 3,000 profit. They want to be done and take care of it. I call this the marshmallow test. Okay, you can take the profit, eat it now, or you can wait to take more profits. That's a preference. Everybody is different. I usually let this thing go because the time decay is, is considerable, and I can wait. If it goes against me, you can see in the next slides, I know how to take care of them. Okay.
So question here, Mo. Now, had the theta been less, what would you have done?
If you have profits, I mean, you have a good safety zone, right? You have a good safety zone. I don't worry about theta. If the stock is above the short leg, I just give it time to close. 20 days is a long time. I start worrying them a week before.
Okay. Now, is there a percentage, like in case of the your P&L or your profit versus the theta? Is there a percentage that you typically like to stay over or below?
I mean, the percentage is 68%, right? If I get 68% of the max profit, I'm done.
Right. Oh, okay.
Okay, that's the goal.
Yeah.
Okay, so in here, still the stock is above the short put. So the next one is delta is at 50% or below. I always look at delta. Delta is the magic thing. Oh, delta is 63% in here. And I have a little loss on this trade. This trade is a Taiwan semiconductor. I have a 20 days to expiration. So this is really in trouble. The stock price is below the short put, but 117 versus 120 the strike. Delta is 63%, as you can see over there. I have a loss in the trade. So I leave the current closing trade in touch. Okay, I just leave it there. So I had this trade to close it for 63 cents. But now I have a loss. To buy it back is cost at $2.70. Okay, but what I do, so I leave the current one in place, I roll the other one. I have one cancel the other. So you select OCO, and you keep the original closing order in place. You generate a rolling order. And in here, when I generate rolling order, it costs 2 cents to roll it to the next month. So I'm roll it from May to June. Okay. But I put more money. I just being patient. I want more money to roll it. And so I just be patient. And if rolled, I have the original credit. I received $1.96, plus I'm getting 75 cents now. So I have a total credit $2.71. And then I get longer time for TSMC to come up. TSMC is a strong company. They are the only company that they can make chips for everybody. So a little pullback doesn't bother me. So the key is, if it's going against you, still the stock is between the two strikes, you try to roll it. Okay? Does everybody know how to do this?
Can you explain some more, please?
Okay. So let's go to Thinkorswim. And what is my TSMC trade? TSMC is one of my favorite stocks. So I have lots of positions here. So this is a TSM. So I have positions everywhere in TSM. The one expiring is over here, okay? So if I look at this trade, so this is I'm trying to close it in here. So I say, so let me just cancel this part, okay? Cancel order. Okay. So this is the original order. I was trying to close it for 63 cents. Then I come here, say cancel, replace. So I leave the first one intact. Then I come over here, single order. I make it one, cancel the other. Okay. Then, which account was that? I have to be in the right account to do this, okay?
It was the NY one.
The end one? Okay, it's this one over here. Okay, so I'm in the right account now. See over here, this was the trade. So one cancel the other. Okay, then I come over here, select those two legs. I keep my control down, select the two leg, and say create a rolling order. Create a rolling order. So usually when I say create rolling order, it next go to the next weekly, but I always do monthly. So for the next week, I can roll it for a 1 cent credit. If I go to the next month, it costs 17 cents debit. Okay, I have to make it the same cancellation, good till canceled, and I'm going to ask for 75 cents.
So what are the execution mechanics of this trade?
So
since you kept the first one too?
So if say the stock goes up tomorrow, this one fills, the first one fills, the other one get canceled. So one cancels the other. If one executes, the other one get canceled.
But if it doesn't execute,
if none of them get executed, then I'll be in trouble. I continue looking at this. So like, say next Monday again, I look at it. If this number 75 is 50, they give me 50, I'll just change it to 50, be done. So you have to monitor them. That's what I'm saying. The last couple of weeks is critical.
Okay, thank you.
Okay, you're welcome. So getting back in here. So if it rolls, now you have another month, and you are making more money. Okay. So the next situation is the stock has gapped down and below the long put. It has gone really down. The stock is in trouble and may not come back at all. And basically, in this situation, you just take the loss. One of the trades, so I had 1 or 2 losses this year or the last 18 months. One was Peloton. Peloton was keeping going down. I decided to take the loss and be done with it. Okay, but there are other situations. This is a good stock, and you believe it will come back. Now you want to buy more time. You rather not to pay more money to roll it. In this situation, you have to spend money to roll it. But what I like to do is, I need to change this. Sorry. Okay. So I want to, I don't want to pay money to roll. I roll it out and widen the spread in this situation. Now, when you roll it in this situation, you are taking the loss. You close the current trade, and you are taking a loss. So in this situation, I had a trade on Zoom. Okay, my short put was 350, but the stock is 319. So this is important to understand. This is the most important part of this. So I leave the original closing order in place again in case Zoom come back. Then I generate an OCO order to roll the short put spread to next month. And I experiment with a new short put spread and lowering both legs. So the goal is to generate a lower short put spread so you have a better chance of success. In this case, I widened the spread. It used to be 10, now it's going to be 20. And also low, so the strike was 330 to 340. When I rolled it, I'm moving it to 330 and 310. So I'm moving both trades lower. And in this case, I'm looking forward to get $2.80 of credit. So this would be the rolling trade. So basically, I'm moving this trade at 350, 340 to the June. Now, the new strikes are 330, 310, which is much safer than 350. Now, I'll tell you something. This trade filled today. So if I go over here, I look at my trades today, the orders filled. If you look over here, Zoom, it filled for $2.95 credit. So I got my previous credit. Now I got more credit. It's wider, and I have another month. I moved it from May to August to give me more time. So I believe Zoom is a strong company. Even though people go back to work, I don't think we'll have these meetings face to face anymore. We have people from all over the place, from California, from Florida. If I go face to face, you cannot sit. You cannot do the trades. So I think Zoom will come back. If you look at the chart on Zoom, so today was down a lot. Now my short strike used to be 350. Now it's 330. So the chance of coming back to 330 is a lot higher. Does this make sense?
Hey, Mo, can I ask you a question, please?
Sure, you can.
I'm just trying to get my mind around how you leave the original order alone and also you roll it at the same time.
Okay. I gave you one example. Let me look at another one. So remember I gave you all the stuff. I have the trades. I showed you this before, right? It was on one of the slides. So in here I have a short put spread on a Generac. Okay. So.
Oh.
Yes. GNRC. Okay. So if I look at this trade over here, this is the trade. I want to close it for 30 cents. So this is, okay, let's start again. Let's start from scratch. Okay, so this is my trade. I want to close it for 30 cents, okay? So let me remove this, assume I have nothing, okay? First, I select these two, the one I want to close. I say create a closing order, okay? And I want 30 cents for this. You got this to here? Good till canceled. Then I come over here, select one, cancel the other, OCO. Okay. Then I select these two. There is a on Thinkorswim, it says create a rolling order. You see that? Create a rolling order.
Yes, sir.
Okay. Create a rolling order. Then I go from May to June. If I roll it, they give me $1.20, right? But I want more money. I ask for $2. Then say good till canceled. That's it.
Understood. Thank you very much.
You're welcome. Now, one thing is, I have one more section in this. Let's see if I'm on my last slide. So this was the trade I did. So the last section of this frequently asked questions. It's almost 8 o'clock. I hate to keep you guys after 8. I have a discussion talking about, is it better delta go to delta 10, which is safer than delta 30? And I have a section, is it a good time? What's a good spread? 5, 10, 20, 30, and 60. So I had some examples there. I have another section. I think Peter was talking about this. Why don't we look at the support line as opposed to delta 30? That's a good idea. But it does the same thing. When you look at delta 30 and support, they come close to each other.
I love Keltner channels.
Yes, right. So I couldn't do any other trades tonight. I am so sorry. But I'm going to stop the recording. And if you guys want to talk about any other issues, I'll be glad to stay on and talk to you. Is that okay?
Yeah, Mo, I have a quick question. What about getting assigned? How do we make sure we don't get assigned?
Okay, when usually they get assigned, the time you get assigned, like that Zoom I was showing you, when the stock really gaps down. So you have to you have to start managing them as soon as possible. Like I did Zoom today, even though I still have like 18 days left. But don't be scared when you get assigned. All you have to do, you get the stock, you just sell it. The short put, you get the stock, then sell the stock right away, and you have more profit in the long put. Sell that to make money on that leg. If you ever get assigned, call me. I'll walk you through it. How is that?
Thank you.
You're welcome. Okay, I guess Ron is doing anything. I'm going to stop the recording. Now, stop the recording. Okay.
This conference is no longer being recorded.
Okay. The reason I'm one other thing I want to show you here. We have this website, right? In here is Plano IBD. I have the indicators. I used them last week. I have the presentations. Okay. So if you look at the presentations, like after tonight, here, Control 1. On these presentations, I did a golden goose for a DFW group. So these two over here, one is the presentation, the other one is the video. If you want to, sometimes it's better to watch it offline than listening to me, because you can stop it, you can go to your think or swim experiment. I also did another golden goose a few days before that one for this group. And that one, this is this one is the presentation. These are the videos. There are 2 videos in that one. So tonight I'm doing short put strategy. This is this one. So later on tonight, I will have the video that goes with this. And the way you know it, you look at these dates. If they have the same dates, one is the presentation, one is the video. Okay. Then in here, I have a cheat sheets. I have indicators. Every time I do I couldn't do it tonight. I have a presentations and I have a Word document that goes through all of our trades. But tonight we did the presentation. And after we are done, a copy of the videos will be in the recording of videos. So these are the videos of the previous weeks we had. 1, 2, 3, 4, 5, 6, 7 videos of the previous weeks. So there will be one more tonight after we are done. So if you want to know how I do certain things, it's too fast on the meeting, or you want to kind of stop it, experiment with it, just look at the videos.
Hey, Mo, is this website is within Meetup?
No, the Meetup doesn't support any files. Early on in the evening, if you look at the chat box, do you see your chat? At the beginning of it, I put the link. This is the link over here. Do you see the chat box? At 6 p.m., I put the link to the chat box. You see that? I guess you don't see my cursor in the chat box. So if you go to the chat box at 6 p.m., you see the link. How to get to this site. You know what I'm going to do? I'm going to put it again at the bottom, so you don't have to look for it. Here, copy. It doesn't want to do it.
Carmen just pasted it as well.
Okay, Carmen, thank you, Carmen. So it's at the end of the chat box. So I highly recommend for you to copy this somewhere so you have it in the future. If you miss a meeting, you cannot come. You can wait a couple hours after the meeting and listen to the video. That's one beauty of this online meetings.
Awesome, thank you. One more question. Is penny increment option by TOS, is that updated automatically?
I think so.
Okay.
I think so. So if you go into Market Watch, okay, and you come over here, you go into Market Watch, you go into Public. So penny starts with a P. So under IQ, go into penny liquid stocks.
Thank you.
You're welcome. Okay. Anything else?
Mo, I have a quick question. Is it better to do this strategy on SPX and NDX and Russell, less variation and risk compared to like an individual stock or company?
I mean, you could do it on anything, right? It doesn't matter. One beauty of ETFs is you don't have earning release to worry about. One thing I like is like ARC. This is Kathy. What's Kathy's last name? Kathy Brown.
Wood.
Kathy Wood. Yeah. So she has a whole bunch of ARC ETFs. They have been beaten down pretty bad because of they are really high growth stuff. So like RKK, RKK over here. So if you look at the chart on that one, this is RKK. So she has really high growth stock. These are very volatile. So right now is at support line almost. You see this? It used to be 159. It is right now is 113. So you can come over here, go into Delta. I need more strikes. So you can go to Delta 30, for example. So the stock is at 113. You can do 104. One thing about this one, they are not round numbers. So I need to have more strikes. So if I go to Delta 30 over here, 104, what's a 104 minus 5? It's 99. You get $1.30. You know, so you can do them with anything. It doesn't matter.
What was that dashed white line that ARC touched? Was that, what is that line? What's the study?
This one?
Yes. Can
That's
you
a
walk us through the chart, like what you're using, those
Yeah, that's
lines?
the same chart that I gave you. So this one is 200-day moving average. The blue one is 50, and the green is 20. So this is kind of looks bearish, but you are at a support line. So the trade we did was 104. Okay. So if I come here on the chart, draw 104. So you can see it visually. You are way below the low that happened in early March.
And is there other two dashed lines? Are those Keltner channel?
This over here, these dash lines?
No. The one that closer, like two lines parallel to each other.
This is cultural channel. The one dotted line?
Yes, that's the one. Okay.
That's cultural channel. The one dots. The blue one is 50-day moving average. The white one is 200-day moving average.
And what? How do you use Keltner channel? I mean, how do you use it? Looks like you.
Okay, so cultural channel, basically what it is, usually the stock moves between upper and lower cultural channel. So when it goes down, like in this situation, is below cultural channel, it typically moves back in a few days, goes up to the top line. This is not a good example. Let me give you something else. Let's look at I might be regret. Let's look at Boeing. See, like Boeing, it is today was kind of at the lower end of cultural channel. So I expect this thing turns around and go up to the top one again. So you usually look at channel, it goes below, up and down, up and down. So you don't want to do a trade when it's on top of the channel, because it typically pulls back.
Thank you very much.
You're welcome.
Hey, Mo, it's
Yes,
Tom
sir.
right here.
Hi, Tom.
First quarter earnings came in heavy this week, and a lot of the CEOs were talking about inflation, not just 1 or 2%, but like 10 or 15% on their raw materials. So they're part of the high growth versus the value stocks. Do you look at that at all? I mean, it doesn't seem like that's not part of your plan.
High
What do you
growth
think of
versus
that?
value.
Yeah, like value would be Horton, high growth would be ARC.
Right. So lots of these stocks that have become so expensive nowadays. So you can see some pullback in them, right?
Yeah.
See, I personally don't believe inflation is going to be too bad, because first, inflation is lots of time caused by lack of labor. We have lots of people unemployed looking for jobs. The other times is caused by lack of resources, and we don't have enough resources because of pandemic. But as pandemic frees up, especially in the United States, people will come up with the resources we need. I believe Powell that says the inflation is going to be a transitory thing. It's going to happen, then it's going to come back. He's not worried about it. I listened to 60 Minutes last weekend. They had the Intel CEO and the TSMC CEO. Okay, The TSMC CEO said the reason they don't have chips for auto industry, you can go look at 60 Minutes online, is because when pandemic happened, they canceled all the orders. Other industry canceled the orders. That's why they have no chips right now. So when you cancel the order, it takes a while to start the machine again. So it's not it's because we have no capacity, it's because it takes a while to make the chips. And they canceled the orders, now they are paying.
Well, I guess they have these new cars, these EVs have like 130 chips in them. So that's a lot of chips that they're going to use sooner or later. I don't know right now, but that's probably got people concerned too.
Right. I mean, the car's becoming chips on wheels, basically. And when it takes 7 months to make chips, you don't cancel your orders. It's not on time delivery. You should listen. You should listen to that 60 Minutes section. They talk to Intel CEO and TSMC CEO. And lumber is the same thing. We just didn't make enough. The factories did not generate lumber. Now we're in trouble. But give it 3-4 months, that will change. That's my view.
Okay. Thanks, Mo.
You're welcome.
Thanks, Mo, for tonight.
Hey guys, you're welcome.
Thanks, Brady.
Thank you, Mo.
Thank you. You all have a nice evening. And
Thank you very much, Mo.
hey, thank you.
Thank you,
I'll talk
Mo.
to you next week.
Thanks for the great advice, Mo.
Thank you.
Thank you,
Thank you, Mo. Appreciate all you do.
Bye.
You all take care.
Right.
Bye-bye.
Hey, Mo, do we have a meeting next week or next month?
Next month. We have the first Monday of the month.
I see. I appreciate the work. Thank you so much. Learn a lot.
Okay.
Thank you.
Thank you. Bye-bye.
Bye-bye.